Hi, it's Darren and welcome to our Fall 2022 update. Please stick with me for the next 15 minutes or so. I want to go through a bunch of data to kind of give you an update on where we are and where I think we're headed. So let's jump in and get started. So we'll start with a word from our lawyers, which I think this says something to the effect that I don't know what I'm talking about. Objects are closer than they appear and your mileage may vary. Okay, so that's fun. So let's talk a bit about what's happened so far. We're getting near the end of the year, only a few more weeks until Christmas and New Year's, and holidays are upon us. So that's your warning to get shopping. But we'll look at what's happened in terms of markets and other things. What are some of the key drivers that I think are the most important elements to be looking at and thinking about? What is working, and more importantly, what I think is actually really interesting now. There's things that even 3 and 4 months ago we wouldn't have gone near that now are actually very compelling to look at. And I'll share with you some updates on the team and on the new office. So stick through to the end because I have a bit of an announcement for you, which I think you'll like. Okay, so let's go through what's happened so far this year. As you know, markets have been down across the board. Didn't really matter, not really anywhere to hide. Canada's outperformed a bit because we have energy, and I'll show you in a minute what energy's done. And also, we don't have a lot of tech. And as you can see, between this S&P 500 and the Dow Jones, yeah, I've talked about this before, the S&P 500 largest companies in the US, but weighted based on size, and the biggest companies at the top were predominantly technology companies. And I use the metaphor of like watching a toddler with a big head kind of walk around as they kind of tipped over, they would follow that way. And that's exactly what happened. I warned that that overweighting of tech in that index was likely to be a problem if those sold off. I totally got that right. NASDAQ, as you can see, down 30. So you can see the tech participants in the S&P 500 had it come down more than the Dow, which has less of that issue. But this is not a North American only thing. The MSCI World Index, and I used an ETF as my proxy for that when I did this the other day, it's down 12. Bonds are actually one of the big surprises. Well, not to me, but for a lot of investors. The US bond market is off about 15.5%. And the reason that's a surprise is I think a lot of people thought bonds were safe, and they don't even, how did that even happen, Darren? I knew it was going to happen. That's why we didn't run a lot of bonds in our portfolios. And a 60-40 portfolio, and the reason we use that is that's really kind of the benchmark neutral position for the vast majority of balanced funds and hedge funds, but pension funds. That's considered a neutral allocation. So 60%, blue chip businesses, 40%, government and investment grade bonds. That is down 16%. So that actually is what the benchmark we tend to look at and looking at our performance. And I'm glad to say that even though we're down too, we're not down as much. We've actually done a good job of outperforming on that. But we'll also talk about currency. We run the largest cross-border practice in the firm and in North America, and we have lots of clients with US dollar exposure and Canadian dollar exposure. And as investors, we've been US centric for a long time. And so I wanted to show you, because I get this question a lot about, hey, where's the dollar going? So here's a 20-year chart of the Canadian-US dollar relationship, and I'm giving you the graph from the Canadians' perspective, because it's probably mostly Canadian clients that are watching this. And you can see we had the big run-up in 2004. That was when China was really building out a lot of its physical economy, so a lot of demand for natural resources, which Canada has. We had the global financial crisis in 2008, so everything came down. And then we had this big run-up again in 2009. And if you remember back then, some of the words that you heard in the news were fiscal cliff. Remember that? Obama was in charge, and there was concern the U.S. might run out of money to run the government. So they worried about what was the limit on the government's credit card, as it were. Canada was considered the darling of the G8 countries. All the investment gurus said you want to be overweighting Canada in your portfolios. Well, I ignored most of that, and that's because I'm 9 years old in my head. So you told me to do it. I'm probably not going to do it. So most of you as long-term clients will remember I told Pedro to sell a lot of our Canadian positions and really almost everything except our bank stocks, move it to US dollars because we were buying it over par. So I was able to buy US dollars for like 98 cents. It was wonderful. And we rotated into all those US businesses that everybody didn't like. And then we got 2 wonderful rates of return from then. As you can see, the currency moved in our direction really hard. And then the U.S. economy went out to outperform, and the U.S. stock market went out to perform all other stock markets in the world. So great trade. Now, where have we been since 2016? Well, as you can see, we've been kind of locked in this channel between 70 and 80 cents, and it's just been bouncing in between there. And today we're smack dab right in the middle. So you can tell, I don't know. It can go either way. I suspect that if energy continues to rise, that means the Canadian dollar should also continue to appreciate. But we're right in the middle of the channel, so it can go either way. The 60/40 portfolio, I want to spend a few more minutes on that. So you can see that big decline. And as I said, that's a neutral portfolio. So there really hasn't been anywhere to hide. Even well-balanced, well-managed funds have all been experiencing this because both the bonds and the stocks went down at the same moment. And just to give you an idea of how bad it is and how rare this is, you can see the Dow Jones talked about back in September. This is the worst year in U.S. history for the 60/40 portfolio. Good news is a month later, they said it wasn't the worst in history, just the last 100 years. So things were improving. But you can see how rare an occurrence that is. And part of it was because the U.S. dollar was stronger, so global investments weren't as good when you put them back in U.S. dollar terms. But also both stocks and bonds went down because interest rates spiked up, which I'll show you in a second. One other thing, and I want you to look at this and hold this thought, we're going to come back to it, which is the strength of the U.S. dollar relative to all these other currencies. So Canada, we've been locked in this kind of dance for a long time. But relative to other global currencies, U.S. dollar has been very, very strong, almost back to where it was after what's called the tech wreck, back before that in 2000. So really, really rare that we're seeing the U.S. dollar be so strong compared to everybody else. But hold that thought. We might do something with this. So I also want to take a bit of time because and share with you what we got right. You know, our performance reports do not show you the money I didn't lose. So I want to share with you some things I think we got right in the last couple of years. The one thing is we didn't chase what was popular. I think everyone should have learned this one in high school. Yeah, like I wasn't that popular and that was okay. So don't chase what's popular. Also, I can do math and I've been around a long time. I've done this for 30 years, 30 and a half years. So there's things that we've seen and patterns that we've seen that we learn from. So I think that actually helped us stay out of a lot of trouble in the last couple of years. Bonds, I said, were going to be return-free risk, so we didn't allocate very much. I got away with as little as the compliance department would generally let me do that. So we didn't run 60/40 portfolios. We had 80/20 and 90/10. I was very, very light on bonds because I saw this potential problem coming when rates went up. We always stuck with quality. We didn't get lured into a lot of meme stocks and things that might have been interesting and got a lot of attention. If it has attention on Twitter, I probably don't own the thing. Let me put it that way. So we want quality investments, and investing should be kind of boring. And good news, that's helped us quite a lot. We've also focused on income, and there's the equation for returns over time is what did you buy it for, and ultimately what did you sell it for, and then how much income did you get while you held it? Well, sometimes the price appreciation thing dominates that math. Other times it's the income component that is the one we want to be focused on. And I'm going to show you a very specific example near the end of how we're really, really doing that right now, because there's some interesting things happening that let us really push on the income side, which I think you're going to like. But in terms of popularity, I'm just picking a few examples because this thing could run 3 hours if I showed you lots of the I told you so's. Because I am the guy that says I told you so and I do hold a grudge. That's just me. So here's one. Peloton. Remember this? Everybody got excited. Well, we're working from home. We're staying home. We're home. We can't go anywhere. I walk the dog. You know, people bought these Peloton things, these really, really nice, expensive, connected bicycles. Now, anybody that's ever bought exercise equipment, whether it was a Peloton or a Bowflex, like what happens, right? You get it, you use it, it's really exciting, and then you hang your clothes on it because who really wants to keep doing this stuff, right? I know, I spent a lot of money not going to the gym for a long time. So what happened with Peloton? It shouldn't really be a surprise. Now they stopped making them because they have too many. And, you know, I don't know if the company will survive as an equipment maker. Maybe the classes keep going, but look, the stock is way down. And unfortunately, this wasn't like, hey, I made money and I gave it back. Most of the investors bought in near the top. And this becomes permanent loss of capital, not permanent loss of weight. Bitcoin. I'll put a link up here to the video I did a while ago where I kind of told you, don't go near this stuff, right? It hasn't worked out well. And now we've got this huge cascading, not yet done problem of this FTX crypto exchange, which was perceived to be the safest, best one. Turns out it was also horrible, and there's billions of dollars that have vaporized, and poor Tom Brady might have to move back in with Giselle because, you know, they were part of the promotion of it. So big mess in crypto. Now, that doesn't mean this technology of blockchain and things isn't interesting, but the value of the crypto stuff, highly debatable. So we'll go back, watch my video about that again, but clearly we didn't go near that stuff. You heard this term called disruptive technology, and this was applied to green energy and biotech, lots of places that this disruptive technology thing came about. You can see how well that's worked out. That was pretty disruptive to your portfolio if you bought it at the wrong time. The example I'm using here is with Kathy Wood, who runs ARC Funds, and her ARC Innovation Fund was the most popular of those investment strategies. It's probably the one that's most emblematic of it. And she's a very smart lady. I got a chance to hear her directly at the Forbes conference in Las Vegas. And, very smart. I think she's right on a lot of stuff. Unfortunately, she became too popular too quickly. And again, this isn't that a lot of people bought in 2018. The vast majority of her investors bought in at the top or somewhere in here. So most of her investor base is off 60 to 80%. That's a really tough thing because long time for that to ever come back, right? So now it might make sense, but I would put this in the same category of picking up a lottery ticket at the gas station. Like, okay, maybe we buy it. If it works out, great. If it doesn't, it's okay. Here's a longer term one that we stayed away from, which was China. So you may remember years ago, we had this investment theme called BRIC, Brazil, Russia, India, China. I ignored it then, but it got lots of attention, lots of popularity. Well, I'm glad we did, because guess what? This is a 10-year chart of the leading ETF that invests in China. Look at that. Yes, it went up, it went down, but over a decade later, it's negative. Like, that's not how you grow your capital. So we didn't do that either. Stayed away from that. And also, this one is a shock to many investors, not to me, because we were really light on bonds. This is the Canadian bond universe over 20 years, so 2 decades. Now, we're ignoring the interest income because there wasn't a lot for a while, but we're just looking at the price. And you can see how rapidly, in just under 2 years, 20 years of price appreciation gone, vaporized, because interest rates spiked up. Return-free risk. Tons of risk baked in the cake, and a lot of investors either didn't know it or didn't think it because, hey, bonds are safe. I grew up thinking that. Well, sorry, not the case. So we didn't get caught in that one. And one of the reasons I learned these lessons is from just having done this a long time. And I've shown you this chart before. This is a chart of Cisco Systems and how you can be right but still be wrong. I know all the married people are going, yeah, I know exactly. So here's an example of one where you can be right on your idea, but you overpaid and turned out you were wrong. So back in the late 90s, when everyone's getting the internet and MySpace and Netscape, and hey, this is really cool. And if you believed in the future that the internet was going to be everything, then the stock you would have wanted to buy, I guess, was Cisco Systems, because it was the most emblematic, the most representative of the internet, because they built the information superhighway. They were the guys paving it, right? And so if you bought it, and you can see how popular it became, at one point it was the most expensive business in the world, and more enormously popular to investors. Well, if you bought it back in the 90s, especially in like 1990, right at the top of the tech fever when everybody was certain what was going to happen, yeah, you lost a lot of money real quick when the balloon popped. And what's really interesting to me is that you were right if you bought it in terms of your thesis, in that we use more internet today than anybody ever thought possible in 1999. We use way more of it now than anybody ever assumed. And Cisco's done great. I mean, their business has grown. They have become, one of the dominant providers of making the internet work. So you were right on your thesis. The problem is you overpaid. You didn't do your math. And now 20 plus years later, you still aren't even halfway back to what you may have paid for the stock. So, and I warn people about, whether it was Tesla or other, these are very expensive businesses. Even though you might be right on your theme, the math matters quite a lot, right? Okay, so let's keep moving here. Inflation. I'll put a link up here to my Walking with Charlie I did when I talked about inflation. And it seems to be a surprise to everybody except the people that should have known it was coming. Like the people that are in charge, the central bankers and governments, how'd they not know? They printed all that money. They did all that. This should not be a surprise that, you get inflation when that happens. And yes, a lot of it was supply chain constrictions and other things. But that's one of the reasons that they're doing what they're doing, which I'll show in the next chart. I look at the data so you don't have to. So one of the things also in here that's interesting is, you know how they used to tell you when you were a kid that breakfast, most important meal of the day, cannot skip breakfast, breakfast sets you up for success? Well, yeah, except now it might become your most expensive meal of the day, because look at cereal. Look at what your morning cereal, coffee and tea, your donut, your bagel, your muffin, your fruit. Like, maybe we're just going to have a glass of water and worry about it at lunchtime. I guess that's intermittent fasting. Is that the new thing? I'm not really current on this stuff. Now, why is inflation happening? Well, I've shown you this chart before, and it staggers me that this is not at the beginning of every business newscast, or every time someone talks about interest rates and inflation, they should just put up this chart. And you can play the home game. Go on your Google and type in FRED, which is the Federal Reserve, FRED M1 money supply graph, and you can follow this with me if you'd like. So this M1 is probably the best primary descriptor of how much money is floating around in the US. And this chart, by the way, goes back to the 1960s. Look what they did. Just look what they did. Look what they printed. And that's why we have inflation. And they've raised interest rates to fight inflation, and yeah, it's making a bit of a difference right at the end there. So in my view, and now we're into this push and pull of, well, how high can they raise interest rates, because now they have to have this Inflation Relief Act because people can't afford it, so we send the money, which causes more inflation. But anyway, I guess people don't want to read the textbooks. So to me, this is the one chart to keep an eye on, because that's going to kind of tell us everything else. So this is the single most important financial weather report indicator to look at, because until this materially improves, we're going to be locked in this battle with volatility of, hey, inflation's running too hot again. Oh my gosh, we've got to raise interest rates. Oh, we can't raise them so much. Now we're going to reduce them. Like, just keep an eye on this. So until this one really changes, we're going to be locked in this cycle for a bit. I'm sorry to tell you that, but that's what I think. And so you can see now, by the way, I think they did this to give themselves some breathing room and make it look like they were doing something to raise confidence. So this is what Canada did. I can show you the US chart, but it's almost the same. They just hit the brake pedal really, really hard, harder than ever, to raise interest rates really, really quickly. And frankly, it's because they left rates too low for too long. So now they're like, we got to give ourselves some room to maneuver. So they cranked up interest rates. Now, we're not going back to where we were in the 1980s, at least I hope not. We're only back to where we were, in 2006, 2007. So not devastatingly high. They would call that normalizing. But it gave them some room to maneuver. It wouldn't surprise me if we're probably getting near done this in the short term. And maybe for political reasons, it may come back down a little bit to make everybody feel like, okay, inflation's under control. But go back to that first chart, the one they can't lie about or tease you about or fib to us about how much they printed. So there's where we are with interest rates, and it's because of that rapidity of change, that pace of change. That's what's caused the turbulence in the bond market particularly, and also in the stock market. And it's hit the tech stocks the most because they're the most sensitive to those changes in interest rates. So that rapid change is why we've seen the turbulence. It may settle down for a bit, but I don't think it's over, sadly. What else has been happening? Well, this guy. Remember this guy? Yeah, how can you forget this guy? Now, by the way, if you're at all offended by my descriptor, come over and talk to me in person and we'll have an argument, because there's no defending this person. This person's responsible for at least 70,000 deaths of his countrymen, and we don't know how many thousands of Ukrainians and other people that have been killed because of his decision making. So anyway, I know it's a bigger conversation, but that's one of the reasons why the world has been a little unstable. What else? These guys. So China, they're having their own economic challenges at home. Their economy's in a bit of difficulty. The real estate market's in some difficulty. They have a no COVID policy, so parts of their country keep getting shut down. And then politically, they're trying to establish their place in the world a bit differently than they have in the past. And it leads to some interesting things, like, for example, last week we watched the president of China publicly scold the Prime Minister of Canada, and that was a bit uncomfortable. So another factor for us to be mindful of. Oh, remember this thing? It hasn't gone away. We still have Corona and COVID. And I've told you before, we're not going to ever see it go away. It's always now a function of how do we just live with this? And we're already hearing, like, do we want, now that winter's coming, do we go back to mask mandates? And like, oh, is this ever going to end? But it's still a thing. It's still a thing. A lot of questions about, is there a recession coming? Are we going to avoid recession? I've said before, I don't really care. We already had one. We had one back when everything got shut down, everything went down. You can see that expansions last so much longer than recessions. If we get a recession, it's the most expected one ever, because everybody thinks we're going to get one. And if we do get one, it's because they engineered it. Like, the central bankers hit the brakes so hard, they put the car in a skid. And it seems like they're trying with what they're doing. So maybe they make it happen. I mean, maybe. But if they do, it's going to be a weird one, because it'll be the first one. And I don't know if there's a textbook chapter on how you have a recession when there's lots of jobs. So unless this changes and companies start shutting down, or we see the job openings vaporize. But as you can see, as recently as August and September, the U.S. Department of Labor said that there were 1.75 job openings for every person looking. So there were lots of job openings at all different levels, skilled, unskilled, like just nobody seems to find anybody. Now, I'm thinking part of that could be that there's new jobs people are taking that aren't measured yet in their data set. Like, I don't know if someone quits their full-time job to become a TikTok influencer, how that might show up there somewhere, but maybe that's part of it. But clearly there's lots of jobs out there, and the job growth and wage growth has been decent. So if we get a recession with lots of jobs, that's weird, because usually it's high unemployment that triggers this, not low unemployment. Anyway, I don't get it. So that's a weird one. The consumer has actually been in really, really good shape. They've been able to maintain really, really strong net worth, lots of assets relative to their liabilities. And even if the home values and things come down a bit because rates went up, that's okay. And remember, Americans, unlike in Canada, people get mortgages, they're either variable rate or maybe they lock them up for 5 years. But Americans generally can have 20 and 30-year mortgage terms. So a lot of these people have locked in their rates for like the rates we've had for a very, very long time. And you can also see that household debt service is the best it's been in 50 years, maybe. My chart only goes back to the 80s. So I don't know what it was in the 70s, probably way worse because interest rates were at 18%. But the average American household has lots of room to maintain their debt. And indeed, they could take on more if they wanted to, but they don't need to because they saved so much money. We talked before about there was several $1 trillion of excess savings in people's bank accounts. Now they're drawing them down, and partially maybe they aren't working, or their circumstances have changed, or they can actually get the stuff they ordered and it's showing up and they got to pay for their new car or their pool or whatever. They're drawing down their savings, but there's still room for them to keep drawing down. And if they run out, then they can go and borrow. There's lots of capacity. So the punch bowl is still on the table. So hard to imagine a weird recession when that's the case. But people are pessimistic. And Dr. Kelly, the guy who at JP Morgan puts these charts together, he actually was also speaking at the conference with Forbes that I attended. And this, he said, was one of his favorite charts because it talks about, it's probably one of the best contrarian indicators. And it's about when people are pessimistic, that's actually a buying signal. And that makes sense, right? Because what's the oldest rule of investing? You want to buy and sell. So what does buying low look like? Well, buying low means everyone who's out is out. All the people are scared and they don't want to buy anything. That's how you get a bottom. And so if you look at when we've had this condition, it's periods that are generally followed by some pretty strong markets after that. So very good indicator in Dr. Kelly's opinion. So I'm going to agree with him because look how sharply it's fallen off. And that might be good for us. So what is working? So energy obviously is working. We've had 30 years of underinvestment in the energy business. And I'm not going to get into any climate change and global warming arguments and that kind of thing. Just look at the fact that what's supply and demand. And right now, there's not a lot of supply. And look at rig counts. Like even with the higher energy prices, there's not a lot of rigs coming on to get us more supply. And I was talking the other day to a hedge fund manager in Calgary, and he lends to the oil and gas industry. And I was asking him about this rig count thing. He's, Darren, no, it's not even going up again. It's going back down. And a part of that is weather. Another big part is they just can't get people to work on the darn thing. So he's like, no. This underinvestment and having tough difficulty getting people is going to see like a very limit to how much new supply can come on stream. And on top of that, see that sharp decline of how much oil inventory is out there? Well, one of the reasons that the oil price has kind of stayed relatively stable, it dropped and then it went up and it's back down again, was because the U.S. has been dipping into their strategic reserves to try and keep the energy prices low, to try and keep inflation in check. I've used this term with you before, which is called Stein's Law, which says if something cannot go on forever, it will stop. And that the genius of that comes back again because they can't keep dipping into the strategic reserves forever, so that will eventually stop. And then guess what? Not only will that artificial depression of the oil price end, then they got to go back and replenish the stock of like up they go. So I have been underinvested as a Canadian portfolio manager in energy for almost my whole career. It's not a sector I've ever liked, but in the last year and a bit, we started allocating to it. And I think the structural reasons why oil did what it did are the reasons we want to be buying it now. Because the companies that were able to survive, because this has been a horrible place to invest for a long time, but the companies that were able to survive when oil was $10 a barrel, $12 a barrel, $25 a barrel, are now making tons of money when oil is at 86 and 95 and wherever else it may go. So this is becoming a larger part of what we think is really interesting to have in our portfolios. What else is really interesting? Fixed income. For the first time in my career, we're actually, well, no, it's not quite true. This is about the third time I've done this trade. If we look at where interest rates have been, 4 months ago, I would not have looked at any of the space because it was pretty clear rates were going to go up. And bonds go down when rates go up. When rates go down, bonds go up. So you do not want to buy them when rates are going to go up. So we didn't do that. Now that rates have surged really quickly, these things now are becoming quite interesting. I don't think we're quite done on the rate increases, so I have time to put this trade together. But have a look at, these are all these different fixed income categories, and look at the little diamonds that are at the top of these things. That's kind of what the future, what the current returns are and what the yields can be. And we're right at the top of the band for pretty much every category. So lots of flashing green lights here. So when we do go back to allocate, and I'll argue we might move back towards that 60-40 mix. It was interesting. I've been at a number of conferences where people were talking about a pretty standard thing was, is it the death of the 60-40 portfolio? And everybody always solves the last problem. To me, you shouldn't have been in a 60-40 portfolio a couple of years ago because the bond part was going to hurt you. And hey, it did, surprise. So I was hearing these things. I'm like, forget, is this the death? I think is this the rebirth of, the resurgence of, the renewal of the 60-40 portfolio. And that's, I think, how we're looking at this is how do we begin going from me being really underweight bonds to back to a neutral weight, but being much more thoughtful about the types of fixed income because it's such a diverse area that we allocate into. And I think the timing of this is very, very good for me to do this now and over the winter time. But if they want to crank rates up, I reserve the right to change my mind at any time. And when we look globally, remember I talked about the US dollar being very strong? Well, when we look at returns in other bond markets around the world, see all the red in both their local currency, whether it was the UK, China, Germany, whatever, but then what is it in US dollars? And as an investor, buy, sell, red is down here. So we want to be buying that kind of stuff because it's been terrible. Now we want to own it. And very similar with respect to global companies. Again, the U.S. has been the best house on the street. That's why one of the reasons why we've been overweight U.S. for a long time. But we're getting to a point where internationally that high dollar and that outperformance of the U.S. will give us even more opportunities outside because dividend yields are looking better and valuations are better. I'm not ready to quite yet, but I think it's very possible that as we go through the winter time, if what I was showing you, Putin, if the UK and Europe really struggle this year because of high energy prices, if they kind of freeze in the dark, we may be able, as opportunistic long-term investors, be able to see some prices in some wonderful companies located there that we may never see again. So I'm imagining we're going to start rotating some of our capital into those places to get those prices for us, which also makes sense as a Canadian investor because Canada is only about 3% of global markets. So it's kind of like shopping in the gas station. Like, yeah, you can get milk and bread, but not, you don't really want to do most of your shopping there. So we can get a few things, but we really have to look elsewhere to get most things. And in the U.S. also, I've shown you this chart pretty regularly about where valuations are in a long-term perspective. And you can see we're pretty much right on this long-term 25-year average in terms of valuation. And part of the correction for that was I kind of called it, if you go back and watch some of the early ones where I said we're a bit expensive. And one of the reasons we're expensive is this overweight to technology stocks. So we didn't really chase into the S&P 500 market. That's why I said it wasn't a good benchmark for us. That problem seems to, in many ways, have corrected itself. So now this, to me, is a more interesting benchmark that I think we'll get a little closer to. We're also not too afraid of volatility. It's like weather. It is. You can't, whether you like it or not, nobody cares. It's just, it is what it is. And we can see that, you know, we're going to finish this year. I'm pretty certain I can say that we're going to finish this year in the negative. I don't know exactly where, but we don't get very many years where we get back-to-back negatives. Indeed, out of the last 42 years, only 10 of them finished negatively. Now, there's a lot of movement in the year. So that's what those red numbers are, is where did it go during the year? Like there's years where, you know, back here in the 08s, like or 1997, markets were down during the year, but they finished really strongly positive. So just, you got to hang on to the seat. I know it's like trying to get you to stay still while you ride the Mindbuster at Canada's Wonderland, but that's the ride we're on. What else? Let's go to some other fun stuff here. Where'd my mouse go? I got too many monitors and too many things happening. Okay, income. This is actually really neat. So covered calls. I think I'll do a whole Coleman Wealth Academy on what covered calls are. So stick with me. So effectively what they let us do is own a basket of companies and I can squeeze them for more income. So I'm just going to focus on the income part of the equation, not on the price appreciation part because that gets more complicated. I just want to zero in on the income side at the moment because if things look like they're going to go sideways, and I said we're probably going to keep getting this volatility, this allows us to squeeze these investments for more income, because one of the variables, one of the factors in the formula for how much income we get paid is volatility. And the more volatile things are, the more money we get. It's really neat, right? But the only way I can think of to turn volatility, which nobody likes, into a real positive for us as investors. So here's an illustration of how much of a difference this can make to us. And by the way, covered calls are actually considered a risk reduction strategy. This isn't taking more risk, it's actually reducing risk. So XFN is an ETF, or an exchange traded fund, and it basically just buys the Canadian bank and insurance companies, right? And its natural dividend yield is 3.3% when I measured this the other day. If I take that same effective basket, now there might be some slight differences, like one guy has a little more Royal Bank and the guy's got more Bank of Montreal, but it's all the same stuff, right? It's that same basket, but now we're going to write some covered calls on it. And our income goes from 3.3 to 10.8. That's a remarkable thing. Now, again, I'm going to ignore the pricing. That's the other part of the formula. I just want to show you this part of the formula and make sure you know that there's strategies we can implement. Now, this is grad school level. This isn't easy stuff, but there's things I can do to take advantage of market volatility. And I feel like I'm walking under your car at the dealership saying, can I show you the sensors? And that's your ABS. And you may not care, but there's some neat stuff that we're able to accomplish for you. And I feel like I need to show you some of this sometimes. So if you want to know more about this, as I say, I might do a Coleman Wealth Academy on it. And if one night you can't sleep, you can watch that one. Okay. Final thought. So this comes from George Katch, who's the Chief Executive Officer at JP Morgan Asset Management. And this was from his 2023 long-term capital market. Aren't you glad I read this so you don't have to? Because it's boring, but I find it fascinating. And he said that lower valuations, higher yields, and the accompanying unwind of many policy dislocations, in other words, fixing some problems, mean that markets today offer the best long-term return potential in more than a decade. So it's been a rough 2 years, obviously, but for long-term investors, the green lights are flashing. And this is what buying low feels like, right? Okay, so let's move off of that. Santa's coming a bit early. We have Christian joining us. We'll do a whole thing with Christian after December 1. So Christian was a summer student for us a while ago. He's a CPA. He's working on a CFA. Wonderful young man. Really, really pleased he's joining us. And I've convinced him to avoid the horrifying nightmare of tedium that is accountancy. I know there's some accountants watching, and you have to agree with me. You have to agree with me. So he's going to be joining us, and he's going to be our own in-house tax expert. Not that we're going to do tax returns. We have other facilities for that. But I want someone that can really be – and look, Ryan we have 4 CFPs on the team. We know taxation, but having a CPA, I think, takes that to a whole other level. Christian's also going to help me with a lot of product and investment due diligence. I just don't have time to be as many places as we've been invited to go to look at things. So I need a little more support there. And I think it's wise I build some more bench strength on the team to do that. And we have access to some really amazing portfolio analytics software that I will confess, I just turned 53 on the weekend. Some of this stuff is just like, it's a Nintendo. It's a video game. I don't know how it works. And I've given up. I can't make it go. So I'm going to get Christian because he's a whiz kid. He's going to take over using some of the software that I will confess. I love it. I've tried playing with it. It's fascinating, but it's not a good use of my time to be on these things. So he will take over ownership of that. And so I think he's going to bring a whole new dimension of due diligence and capability to the team. And we're delighted to have him. He's also a super young man. So you'll be impressed with him. And I know his mom and dad, and they're wonderful people. So not surprised they raised a good boy. Oakville, we're now moved in. Our furniture's arrived. Now it needs a little bit of decorating. So we'll get to that. If you'd like to come and visit sometime, please do. I'm the boss. It's my office, so I made it dog friendly. So Charlie will be here sometimes. There's some dog beds and some treats. So if you want to come and visit, just let me know, and we'll try and make sure Charlie's here when you come here. And he's lovely. He only has 7 teeth, and he doesn't bark unless you're a butterfly. I don't know what he's got against butterflies, but that's the only thing he barks at. It's so weird. He just loses his stuff. I don't know why he doesn't like butterflies, but that's his thing. Anyway, so with that, thank you very much for your time. I wish you a safe, season's holiday shopping season. You better hurry up, get your Amazon stuff in, or head to the mall, get your mask on again. Be safe, and we'll talk to you. If I don't see you, have a wonderful holiday, and we'll see you in the new year. Thanks very much. Bye-bye.